There is a guy in Columbus, Ohio, 49 years old, earns $110,000 a year, maxes his 401k every single year without fail, drives a paid-off Honda, brown bags his lunch, skipped his last 3 vacations to keep his savings rate up. Personal finance Twitter would call him a hero. He is going to retire at 65 with roughly 40% less money than his spreadsheet projected. And the reason is not that he didn't save enough. The reason is that he spent the last 8 years optimizing the lever with the least mechanical advantage while leaving the 2 levers that actually move his number untouched. There is a specific age when saving more stops being your highest leverage financial move, not a vague era, a calculable threshold. An exact mathematical crossover that you can locate on your own balance sheet in about 4 minutes. Once you see it, you will never look at save more advice the same way again. I'm going to give you the formula, the real numbers behind why it exists, and more importantly, what you should be doing instead after you cross it. And before we get into any of this, the financial advice industry has a structural reason to never put this in a headline. I'll show you precisely what that reason is and why it costs the average American between $45 and $55, somewhere between $80 and $120,000 in lifetime retirement wealth. They are surrendering without realizing it. What I'm going to lay out today is a framework built on 3 levers. Lever 1, how much you save. Lever 2, what return you earn. Lever 3, how much time you have. The financial advice universe treats these as equally important at every age. That is categorically, mathematically wrong. The power of each lever shifts dramatically as you get older. And if you're still pulling the savings lever as your primary strategy at 50, when you should be obsessing over return efficiency, you are not just leaving opportunity on the table. You are choosing the lowest return action available to you while feeling disciplined about it. By the end of this video, you will know exactly where you sit, what your highest leverage action is right now, and why the advice to save more is some of the best guidance you can receive at 30 and genuinely counterproductive as a primary strategy after a specific threshold. By the way, I built a free early retirement calculator because most of the ones online are mathematically wrong. They use return assumptions that happen to make certain annuity products look competitive. Mine uses the actual modeling frameworks from BlackRock and Vanguard to expose the specific weak points in your plan. I only ask for your email to send the report. I don't store any of your financial data. Link is in the description. Here is the metaphor I want you to hold through everything I'm about to say. Think about a rocket launch. Before liftoff, everything is about fuel. Every pound of propellant you load matters enormously because you are fighting Earth's gravity. And that requires overwhelming force applied early. The first few minutes of flight consume more than 90% of total fuel. But the moment you reach orbit, the moment you have escaped the gravity well, the physics change completely. In orbit, you don't need constant thrust to maintain velocity. You need to eliminate drag. You need your engines pointed at the right destination. What you do not need is someone at mission control frantically loading more fuel onto the launch pad you left behind. The launch pad is empty. You're in space now. Your savings habit is the launch pad fuel. Your portfolio is the rocket. And the age when you leave the atmosphere, when compounding takes over from contribution as the primary driver of your retirement wealth, is exactly what this video is about. Most people cross that threshold without noticing it. They keep running back to the launch pad. The rocket is already gone. In a few minutes, I am going to tell you about a specific psychological mechanism that makes smart, disciplined people double down on exactly the wrong behavior after 45. It is not stupidity. It is a rational response to a broken information environment. But first, let me do the math that makes all of this concrete, because everything else I say will rest on these numbers. The 3 levers are not created equal, and their inequality increases with age. At 25, time is so powerful that even a modest savings rate invested consistently produces enormous wealth by 65. $10,000 invested at 25 at 7% annual return becomes approximately $149,700 by 65. No additional contributions. That is nearly 15 to 1. The same $10,000 invested at 45 becomes approximately $38,700 by 65. 4 times less productive. Same money, same return rate, same destination, different starting point. Time is doing the heavy lifting, and when it's gone, it's gone. You cannot save your way into more time. This is why start early is the single most correct piece of financial advice ever given. It is also almost entirely useless to someone sitting here at 51. Here is where the conventional logic collapses. The standard follow-up to start early is, if you started late, compensate by saving more. This sounds rational. It is wrong. Not completely, but wrong about the magnitude of the impact. Take someone who is 50 years old with $200,000 already invested. They plan to retire at 65, 15 years. They currently contribute $12,000 a year, including employer match. What is their highest leveraged financial action? Option 1, save more. They find an additional $5,000 per year to contribute. Over 15 years, at 7%, those extra contributions generate approximately $125,000 in additional wealth. Real money, not nothing. Option 2, optimize the existing portfolio. Instead of saving more, they spend the same energy reviewing what they own. They are sitting in an actively managed fund with a 1.1% expense ratio. They move it to a comparable index fund at 0.06% and rebalance toward an allocation more appropriate for a 15-year horizon. Their effective net return moves from 6.1% to 7.5% on their existing $200,000. At 6.1% over 15 years, they end with $481,000. At 7.5%, they end with $585,000. That is a $104,000 difference from a single portfolio decision, without contributing an additional dollar, without cutting a single subscription, without packing a single extra lunch. You think the problem is that you are not saving enough. The actual problem is that the money you already have is running at the wrong efficiency. Nobody told you, because nobody who profits from your financial decisions has an incentive to frame it that way. The crossover point is calculable. When your total investable portfolio equals roughly 10 to 12 times your annual contribution amount, the return lever and the savings lever reach approximate parity over a 15-year horizon. Beyond that ratio, return rate becomes the dominant driver of your retirement outcome. For someone maxing their 401k at $23,500 per year in 2026, the crossover hits around $235,000 to $280,000 in total savings. For most Americans contributing consistently since their late 20s, that threshold arrives somewhere between 43 and 49. Most people cross it without any fanfare. No alarm goes off. No one calls. The Federal Reserve's 2022 Survey of Consumer Finances shows the median retirement savings for Americans aged 55 to 64 sits at approximately $185,000. Those people are right at the edge of the crossover. Many have already crossed it, and the overwhelming majority are still treating savings rate as their primary lever. They are loading fuel onto a launch pad they can no longer reach. Now I want to introduce someone who will reappear several times before this video ends. His name is Dave. Dave is 48. He earns $85,000 a year. He has $190,000 in his 401k. 6 months ago, he read a personal finance book, the one with the coffee cup on the cover, you know the type, and decided to get serious. He added an extra $400 a month to his contributions. He canceled streaming services, stopped ordering takeout, sold a motorcycle he genuinely loved. His wife noticed he seemed stressed. He felt behind. And contributing more money was the only tool in his mental toolkit. Dave is not wrong to save. Dave is wrong about where saving ranks on his priority list right now. I will finish Dave's story before we're done. But first, fees. I know you've heard about fees. I know you're nodding like you've got this covered. You probably do not understand the specific way fees interact with the crossover point, so stay with me because this next part changes the math in a way that is, frankly, hard to look at calmly. The average actively managed mutual fund in the United States charges an expense ratio of approximately 0.66% per year, according to 2023 Investment Company Institute data. The average index fund charges about 0.06%, a gap of 0.6%. Here is what that gap actually costs. On a $200,000 portfolio with no additional contributions over 30 years at a gross return of 7%. At the full 7%, you end with $1,522,000. At 6.4% after the fee drag, you end with $1,098,000. Cost of the fee, $424,000, more than twice your original investment. Paid to a fund manager who, statistically, had an 88% chance of delivering a worse return than a passive index you could have bought for 6 cents per $100. That 88% number is not an exaggeration or a one-off finding. The S&P SPIVA report, published in 2023, the most comprehensive fund performance database that exists, shows that over 15 years, 88% of US large cap active managers underperformed the S&P 500 index. 88%. You are not trading a fee for expertise. You are paying a premium for statistically likely underperformance. The rocket has a hole in the engine, and the engine is burning your compounding and venting it into the marketing budgets of fund companies. By the way, hit subscribe if you're finding this useful. YouTube's algorithm may genuinely never show you my videos again if you don't. And I mean that in the most literal, non-manipulative sense. That's simply how the recommendation engine works. Now here's why this fee problem scales with age specifically. Before the crossover, you are adding so many new dollars that fee drag is diluted across a growing base. After the crossover, your existing portfolio's returns dominate the math. At 50 with $200,000 at 7%, your portfolio earns approximately $14,000 in year one. A 1% fee drag costs you $2,000 of that, roughly 14% of your annual gains consumed by fees. If you were 25 with $20,000 contributing $15,000 a year, the same 1% fee costs you $200 against $15,000 in new contributions, a rounding error. Fee drag becomes a larger percentage of your annual wealth creation precisely at the moment you've accumulated real money to protect. It scales up exactly when you can afford it the least. And Morningstar's long-term performance research shows that the combined drag fees plus the return gap versus the passive benchmark averages 1.2 to 1.5% annually over 10-year periods. On a $200,000 portfolio, that translates to roughly $2,400 to $3,000 per year in wealth you are not building every year, silently. On a quarterly statement that buries the performance comparison 7 pages in, right after the regulatory disclosures nobody reads. Financial advisor, you're paying for active management. That's a professional watching your portfolio. Investor, is he watching it underperform the index? Advisor, he is watching it very carefully. Now stay with me, because there is a third dimension of the return lever that almost nobody discusses, and it might be the highest leverage action available to anyone between 45 and 60. It is not allocation, it is not fees. It is tax efficiency specifically, a strategy that creates a window most people walk past without noticing. When you move from accumulation to the crossover phase, there's often a brief period, sometimes when you retire early, sometimes in your late 50s, if your income dips, where your taxable income falls into a lower bracket temporarily. That is the window for Roth conversions. You take money sitting in a traditional 401k or traditional IRA money that will be taxed at ordinary income rates whenever you withdraw it, and you convert it into a Roth account, which grows and distributes tax-free forever. The math is worth sitting with. A Roth conversion of $50,000 in a year, where your effective federal rate is 22%, means you pay $11,000 in taxes now, permanently eliminating the tax burden on all future growth of that $50,000. If it grows to $200,000 over 15 years inside a Roth IRA, you avoided taxes on $150,000 in gains. At a future effective withdrawal rate of 24%, which many retirees hit once, required minimum distributions begin at age 73. That is $36,000 in taxes. You no longer owe. You paid $11,000 now to avoid $36,000 later. That is a guaranteed 30% return on $11,000. Tell me where else that exists. The financial advice industry systematically underemphasizes this strategy. The reason is not complicated. During the conversion year, you move money out of one account type and into another. It does not increase total assets under management. It does not generate a transaction fee. It is, from the advisor's business perspective, unprofitable to recommend, not a conspiracy, an incentive. An incentive that results in millions of Americans paying a lifetime tax premium that a single conversation with a tax professional could have eliminated during their highest leverage window. This is where I want to zoom out and address the psychological architecture underneath all of this. Because the math is only half the story, and honestly, the half that matters less. There's a concept in behavioral economics called effort-reward coupling. It describes the deeply wired human tendency to believe that the amount of effort you put in is proportional to the reward you receive. This belief is often correct in physical work, in creative output, in learning. It is frequently false in investing, because investing is a system with counterintuitive leverage points, where the highest reward actions are often the least effortful and the most emotionally unrewarding. When a 48-year-old feels behind on retirement, effort-reward coupling activates immediately. The rational feeling response is to work harder, spend less, sacrifice more, push the contribution number higher. This produces a visible output, a larger number on the quarterly statement. It feels like control. It feels like progress. It may even be progress relative to doing nothing, but relative to the leverage available through return optimization, fee elimination, and tax strategy, it is frequently the third best action, sometimes the fourth best, dressed up in the costume of discipline. Here is the deeply uncomfortable part. The action that requires the most day-to-day sacrifice, cutting expenses, living on less, grinding out additional contributions month after month, is frequently less powerful over a 15-year horizon than a single 45-minute portfolio review that requires no ongoing sacrifice whatsoever. The most effortful path is not the most efficient path. An effort-reward coupling makes it almost neurologically impossible to feel that without a data intervention. I have run my own business for over 10 years. I've sat across from accountants and fiscal lawyers who showed me repeatedly in specific dollar amounts that the most expensive financial mistakes intelligent people make are not math errors. They are framework errors. They are people applying the correct tool to the wrong phase of the problem. Saving more is the correct tool. It belongs at the wrong phase of the problem once you have crossed the crossover threshold. But now you might think, okay, optimize returns, reduce fees, do the Roth conversion. But what about risk? What if the market tanks at 53 and I don't recover before retirement? This is a real question, and it deserves a real answer, not a wave of the hand. There was a man, call him Richard, who owned a small manufacturing business through the 90s and 2000s. Richard understood returns intuitively. He was deeply skeptical of fees, skeptical of advisors, skeptical of the save more narrative because he had built his business on leverage and efficiency. He was, in many respects, correct about the framework. But Richard drew the wrong conclusion from the right insight. Instead of optimizing his existing diversified portfolio for lower fees and better allocation, he concentrated it. He put 70% of his retirement savings into a single real estate investment trust. In 2006, it had excellent recent performance and a fee structure he liked. He had $2.1 million at age 52. By 2009, he had roughly $840,000. The sequence of returns risk, the risk that a severe loss lands at the worst possible moment in your accumulation timeline, erased a decade of compounding in 24 months. Richard understood the return lever. He did not understand the risk-adjusted return lever. Those are different instruments. Optimizing return rate does not mean chasing the highest available number. It means maximizing your risk-adjusted, fee-adjusted, tax-adjusted net return within a diversified structure appropriate for your specific timeline. For someone 15 years from retirement, that almost certainly means broad market index funds with a moderately aggressive equity tilt, not concentrated bets, not active sector rotation, not anything that requires predicting the future. The S&P 500, measured from 1926 through 2024, nearly a century of data covering the Great Depression, multiple wars, oil shocks, the dot-com implosion, the 2008 financial crisis, and the 2020 pandemic, has returned approximately 10.3% annually before inflation and roughly 7.3% after. There are very few 30-year windows in that entire history where a diversified investor lost money in inflation-adjusted terms. The long horizon normalizes even ugly markets. This is not cheerleading. This is what the data shows. And now I want to make a point about target date funds specifically, because they are where the majority of American 401k assets currently live, and they deserve a moment of focused skepticism. Target date funds are designed to automatically shift your allocation from aggressive to conservative as you approach retirement. Conceptually sound. The execution is where it gets interesting. Most major target date fund families, and you can verify this by reading any of their prospectuses, begin meaningfully reducing equity exposure roughly 20 to 25 years before the target date. Which means if you are 50 years old with a target date of 2040, your fund may already be actively de-risking toward 45 or even 40% equity. For a 50-year-old with 15 years until retirement and 25 or more years of life expectancy thereafter, a 45% equity allocation is almost certainly too conservative. Vanguard's own retirement income modeling consistently shows that retirees with a 30-year payout horizon need higher equity exposure than most target date funds provide, specifically because the inflation risk. An overly conservative portfolio is nearly as dangerous as market volatility risk when you're living off a fixed pool of assets for 3 decades. Morningstar has documented this as well. Target date fund equity glide paths have historically been calibrated to minimize short-term volatility complaints rather than maximize lifetime retirement income. The design serves the provider's customer service department more than it serves your retirement account, which means the default option, the thing HR auto-enrolled you into, the thing that feels safe and automatic, may be slowly costing you 0.5% to a full percent in annual return, precisely at the age where every basis point produces the largest compounding effect. The rocket has drag. It was built into the factory settings before you even touch the controls. Let me now give you a full case study with specific numbers, someone who could genuinely be you. Marcus is 52 years old. He earns $115,000 a year. He has $220,000 in his 401k and $40,000 in a taxable brokerage. $260,000 total in investable assets. He contributes about $12,000 per year, including employer match. He plans to retire at 67, 15 years. His current allocation, 60% in a target date fund charging 1.1% annually, 30% in an S&P 500 index fund at 0.03%, and 10% in a bond fund at 0.2%. Blended effective expense ratio, approximately 0.7% per year. Current trajectory, $260,000, growing at an effective 6.3%, 7% gross, minus 0.7 in fees over 15 years, plus $12,000 in annual contributions, lands him at approximately $885,000 at 67 at the 4% rule. That is $35,000 per year in safe withdrawals. Combined with an average Social Security benefit of around $23,000 annually, Marcus is living on $58,000 a year, not catastrophic, about 40% below his working income. Now apply lever optimization. Marcus moves 80% of his portfolio into broad market index funds at an average expense ratio of 0.06%. Effective return climbs from 6.3 to roughly 7%. He does not increase contributions by a single dollar. Same $12,000 per year, same 15 years, same retirement age. At 7%, $260,000 plus $12,000 annually for 15 years lands at approximately $965,000. That is $80,000 more from a 45-minute portfolio rebalancing session that cost him nothing. Now, Marcus also adjusts his equity allocation. At 52, with a 15-year horizon, his target date fund has been slowly de-risking him toward 55% equity. He moves to 73% equity within his index fund structure, still diversified, not concentrated, which historical data suggests adds roughly 0.5 to 1% of additional annualized return given his timeline. At 8% effective return, $260,000 plus $12,000 annually for 15 years reaches approximately $1,040,000. A 4% withdrawal rate, $41,600. Add $23,000 from Social Security. Marcus is living on $64,600, about 56% of working income. Not perfect, but meaningfully better, and achieved without contributing one extra dollar. What would maxing contributions have done instead? If Marcus had increased from $12,000 to $23,500 annually, an extra $11,500 per year at his original 6.3% return, he would have added approximately $250,000 in additional wealth. That brings his total to around $1,135,000. A larger number, but it required $11,500 more dollars per year. For 15 years, $172,500 in total additional contributions over the period. The lever optimization, requiring zero extra dollars, produced results competitive with, and in some scenarios, exceeding years of aggressive extra saving. The combination of both is obviously superior. But if Marcus can only do one thing, the data tells him which one has more leverage per unit of effort. Marcus is not in a savings problem. Marcus is in a fee and allocation problem that has been misdiagnosed as a savings problem by every default tool he's used to evaluate his retirement readiness. There is also one more angle inside Marcus's situation that doesn't get discussed enough. Asset location, not asset allocation, asset location. The question of which assets live in which type of account. Marcus has $40,000 in a taxable brokerage. Right now, he holds bond funds in that account. But bonds generate ordinary income taxed at your highest marginal rate every year. Equities in a taxable account generate mostly long-term capital gains and qualified dividends taxed at a significantly lower rate. By flipping the structure, holding equities in the taxable account and bonds in the tax-advantaged, 401k Marcus eliminates an ongoing tax drag without changing a single element of his overall allocation or risk profile. It is pure efficiency. It costs nothing. It requires one afternoon of paperwork. It does not appear in the personal finance books with coffee cups on the covers. Now let me bring Dave home. About 4 months into his extra $400 per month savings commitment, Dave's company switched 401k administrators. During the transition, he had to log in and reselect his fund allocations. For the first time in probably 3 years, he actually looked at what he owned and what it cost. His primary holding, about $114,000. 60% of his balance was in an actively managed mid-cap growth fund, charging 1.08% per year. The new platform offered a total market index fund equivalent at 0.04%. Dave did not know he was paying 1.08% on $114,000. He had enrolled in that fund on his first day of work 9 years earlier and never changed it. He did not know the fund had trailed its benchmark by 1.3% per year over the preceding decade. He did not know this combination had been quietly costing him somewhere around $2,700 per year in wealth that was never compounding. Dave made the switch. He moved into 3 index funds: total US market, international developed market, and a short-term bond fund, the classic structure. It took him 45 minutes, including hold music. He did not increase his contributions. In year 1 after the switch, his portfolio grew at 9% versus his previous fund's 8.1% net return. On his $190,000 balance, that difference was about $1,700 in year 1. His extra $400 per month contributions over the same year generated $4,800. The portfolio optimization alone generated about 35% of what his extra contributions generated. But now watch what happens over time. The return difference does not stay at $1,700. It grows with the portfolio. By year 10, With his portfolio having grown to roughly $420,000 at 9% versus $380,000 at 8.1%, the same 1 percentage point efficiency improvement is generating roughly $4,000 more per year in compounding. Meanwhile, his $400 per month extra contribution stays fixed at $4,800 per year. The gap between the two strategies narrows and then crosses. The portfolio optimization, which required no ongoing sacrifice, eventually generates more per year than the contribution increase that required monthly sacrifice of lifestyle. Dave did not need to save more. Dave needed to read the document he had been ignoring for 9 years. The launch pad he kept running back to was 30 miles away. The rocket had been in orbit for a while now. Here are 3 takeaways: specific, non-generic, calibrated exactly to this topic, and not transplantable to any other personal finance video. First, calculate your crossover ratio today, right after this video ends. Divide your total investable portfolio by your total annual retirement contribution, including employer match. If that number is above 10, you have mathematically crossed the threshold where return rate is at minimum equally powerful as savings rate over a 15-year horizon. Write that number down. It is the single best diagnostic of where your financial energy should be going right now. If the number is below 10, keep the savings lever as primary. If it's above 12, the return lever is dominant. Stop loading fuel onto the launch pad. Second, before you increase your contribution by a single dollar, go find every expense ratio on every fund you own today. Not next week, today. Log in, pull up the fund details page on every account. If anything is charging above 0.2%, search for an index fund equivalent within the same account. If it exists, and in most modern 401k plans, it does move the allocation. This is empirically the highest return financial action available to most American investors in their 40s and 50s. The fact that no one leads with it tells you something specific and non-flattering about the advice industry's incentive structure. Third, if you are between 55 and 62 and have not run a Social Security delay analysis, run one this week on the SSA's free tool. Every year you delay claiming past 62 increases your monthly benefit between 5 and 8% depending on your birth year. The window between 66 and 70 represents the maximum 8% annual guaranteed increase. If you can structure your early retirement years to draw from portfolio assets from 67 to 70 and claim Social Security at 70, the lifetime income difference for an average benefit holder can exceed $60,000 to $80,000 across a 20-year retirement. That is not a rounding error. That is a government-backed, inflation-adjusted payment increase achieved entirely by reading the rules. Lazy investing built more fortune than crypto memes. And here's the final observation, the one that ties the rocket back to the launch pad. The people who built lasting wealth slowly, consistently, and without drama did it by reading the boring documents everyone else was too impatient to open. The prospectus, the expense ratio table, the Social Security benefit estimator, the tax code section on Roth conversions. That is where the money actually lives. Not in the next stock tip, not in the aggressive savings regime, not in the motivational book with a coffee cup. The ones who spent their 50s grinding out extra contributions while their high-fee funds quietly tax their compounding, they are still working at 68, genuinely confused about what happened. The ones who found the leverage, well, they've got time to think about other